Hello everyone, this is Bhavik Chokshi here again. Hope your preparations for FR have started for number 19. So this is the second and the last part of the video where we discuss the sums which are introduced as a part of the new study material, which are also relevant for the November 19 new syllabus exams. So this is an important video, and we will be covering slightly more important sums in this video as compared to the earlier ones. So we had covered up to, I think, property, plant and equipment in the last video. Now the new additions are in the form of employee benefits, Ind AS 19. There are fairly good questions over here. We'll try to solve these questions as well. So let's get started. So you should be on illustration number 4. This is on your page 32 of the additional sheet. Just quickly go through it. AJ Limited is engaged in the business of trading chemicals, having a net worth of 150 crores. The company's profitability is good, and hence it is introducing various benefits for employees to keep them motivated and to ensure that they stay with the organization. The company is an associate of RJ, which is listed on the BSc. It's just an introductory paragraph, nothing relevant over here. The company initially did not have any HR function. Over the last 2 years, the management set up the function, and now the HR department takes care of all the benefits. Again, there's nothing relevant, just an introductory paragraph. Now comes the relevant part of the question. One of the employee benefits involved a lump sum payment to the employees on termination of service that is equal to 1% of the final salary for each year of service. Consider salary in 1 year is, in the first year is 10,000. It is assumed to increase at 7% compounded. Okay. Taking a 10% discount rate, you are required to show the benefits attributable each year and the obligations in respect of obligations would mean the liability in respect of the benefits each year. For an employee is expected to leave at the end of year 5. Following assumptions might be taken. There are no changes in actuarial assumptions and no additional adjustments are reflected for the probability. Okay, so what we can do is we can use that set of information to solve the question. So over here, just a second. Okay, so over here we have this question 1, illustration 1. So we are looking at an employee who in year 1 has a salary of 10,000. The inflation or price increase is salary increase is around 7% per annum, and the number of years that is expected to stay with the company is 5 years, and the employee benefit that is being promised is 1% of the last drawn salary into the completed years. So for each year that he renders in service, he is going to be given 1% of his last drawn salary, which means you have to estimate the last drawn salary. So this depends on the number of years he is staying with the company, which is, by the way, 5 years. And as a result, we will say that 10,000, which he is receiving in year 1, will be increased by 7% in year 2, then in year 3, then in year 4, and then in year 5. So for a matter of 4 years, there will be a price increase. That is 10,000 into 1.07 raised to 4. Remember, he is staying for 5 years. However, you have been given salary at the end of the first year. So 1.07 into raised to 2, 3, and 4. So this is around 10,000 into 1.3108, let us say, in which case this comes to 13,108. So his last round salary is estimated to be 13,108. So for each year that he renders into service, the benefit that is attributable, the first part of the question says what is the benefit attributable. The benefit is attributable is 13,108 into 1%, that comes to around 131 for each year of service. That is the benefit attributable. So this is a fairly straightforward part. The second part asks you to find the liability at the end of each year. Now, how do you find the liability? We can actually build up a table over here. So we start at year 1 and we try to figure out what. Okay, let's try it on the new page. We start at year 1. We'll try to find the opening liability at the beginning of year 1, that is the starting of the year. There is no opening liability. Ideally, this liability has to increase due to interest, which is charged, let us say, at the rate of 10%. There will be no interest. And then there will be something called as current service cost. Current service cost refers to the benefit that is attributable for each year's service. Now, we have already figured that the benefit attributable is 131. But remember, if you render 1 year's service, you will be entitled to 131 but not immediately. You will be entitled to 131 on the first year service. You will be entitled to that 131 after another 4 years. You are staying for 5 years, 1 year is already passed. At the end of the year, you are trying to find the liability. You say yes, till date 131 is accrued, but that 131 is actually payable after 4 more years, and hence you will try to find the present value 131 into the present value factor at the rate of 10% for the 4th year, which is around 0.683. And this is 131 into 0.683 comes to around 89, and that will give you the closing liability value. So at the end of year 1, the question asks you to find the liability, it will be 89. Now when you go to the second year, your opening liability is 89. However, this 89 by the end of the year is 1 more year closer, and hence you will charge interest at the rate of 10%, that is 8.9. Let's round it off to 9. And because you have rendered the second year service, you will also be entitled to another 131, but this 131 is payable now 3 years, and hence you do 131 into 0.751, that is the third year's discount factor, that is around 98. So we have 98 plus 9 plus 89 comes to 196. This is the liability. Then you go to the third year. This is 196. You will repeat the same process actually. And this is around 20, 19.6 into 10%. And then you have 131, which is now payable. You are at the end of the third year, so it's now payable 2 years later. That's 0.826. You can take the 10% discount factors into 0.826 comes to around 108. And hence, your closing will be 196 plus 20 plus 108, that is around 324. Go to the 4th year, that's 324, 10% is around 32. 131 is now payable after a year, that is into 0.909. 131 into 0.909 is around 119. So this is 324 plus 32 plus 119 comes to 475, and then in the last year, now this is when the employee is expected to leave, this is 475, 10% of that is around 47 or 48 as the case may be, and you have 131 which is now payable once the employer renders the service, he leaves, and hence it is payable immediately, and hence we have 475 plus 48 plus 131, that is around 654. This is your final liability. You could have also calculated this directly if you want to, because now that you have rendered service, this is into 13108 into a period of 5 years. That should come to roughly the same answer, except for a bit of rounding off over here. So the question asks you to find the liability value. So this should be the value of your liabilities. The question asks you to find the benefit attributable to each year of service. Well, this should be 131, which is benefit attributable to each year's service. Okay, so that takes care of the first question. It's an important one. All the questions I would say in this edition of Index 19 are important. Next, so this is the institute has solved it in a slightly different way. We will be solving it in a slightly different way, though if you see the answers still remain exactly the same. Okay, next is illustration 10. Now it's more of a theory-based question. Over here, the question is trying to ask you on how should gratuity be accounted. Gratuity is generally payable to those employees who complete 5 years of service. But if an employee leaves the company because of his permanent disablement or there is a death, then gratuity is payable even if he has not completed 5 years. Also, the maximum gratuity as per the current Indian law would be, let's say, around 10 lakh rupees, and hence the question is trying to ask you how should you do the gratuity accounting. Ideally, you will try to find 15 by 26 into the last drawn salary into the completed years of service. That will give you the gratuity entitlement. Like we did in the last question, we did 1% into the last drawn salary into 1 year to find 1 year's entitlement. You will do exactly the same thing. You will do, let's say, 15 by 26, or roughly speaking 1 by 2 into the last drawn salary. You will estimate the last drawn salary and into 1. So that will give you entitlement for each and every year. So for which employee should you do this calculation? Well, you should do this for only those employees which you are expecting to continue beyond 5 years, or those employees which are expected as a percentage to die or to be permanently disabled within 5 years. So you will find out of your total employees, let's say 1,000 employees, those many employees which are either expected to die or permanently disabled because their years of service now would not matter, or those employees out of the remaining which are expected to continue for beyond 5 years. you will find those total number of employees. So for example, you have 1,000 employees and you expect 1% of them to be permanently disabled or die. That's around 10 employees. So for 10 employees, and out of the remaining 990, you expect, let us say, half of them to complete 5 years. So that is 990 divided by 2. So that comes to, let us say, 495. So 495 plus 10, that is 505 employees. You should do this calculation. Now, till when will you keep on doing this calculation? Well, you will keep on doing this calculation till the time the employees' benefits reach 10 lakhs. The moment your benefits reach 10 lakhs, future year service will not contribute. So, if you are expecting to stay for 10 years in the company, however, on completion of 8 years, your entitlement of 10 lakhs is over. Then whether you render the 9th year service or you render the 10th year service does not really matter. There will be no CSC. So it's basically a theory question. There is no solution over here. The institute has taken numbers in the solutions to give you some examples. It's essentially a theory question. If you want to understand gratuities accounting well, you should refer this illustration number 10. There's nothing solved over here as such. It's more of a theory based question. Go to illustration number 11 then. ICAI Limited is one of the old companies. So the first paragraph over here is again an introductory paragraph. There's nothing much over here. The second paragraph says the company has a large employee base. The company provided a defined benefit plan. Okay, so the amount of contribution does not mean it's the expense. It's a defined benefit plan to its employees. The following is the information relating to the balance of the fund's assets and liabilities as at 1st April 11 and 31st March 12. So the present value of obligation, this would be the liability, and fair value of plan assets, this would be the assets. Okay. For the financial year ended 31st March 12, the current service cost was 55 lakhs. Okay. And the company made a contribution amount of 111 lakhs to the plan. No benefits were paid. Consider a discount rate of 8%. You are required to compute the balance to be included in the balance sheet. Okay, what is shown in the balance sheet? Ideally, the amount to be shown in the balance sheet is the value of the liability minus the value of the asset. That is the amount to be shown in the balance sheet. The net benefit as on 31st March, and the amount to be recognized in the statement of profit and loss account. What goes in the profit and loss account? Well, usually the current service cost, usually the interest cost, at least from the perspective of this question, should go to the profit and loss, and the other comprehensive income. Now, what goes to the other comprehensive income? Usually the remeasurement items. What are the remeasurement items? There are 3 items in the remeasurement, if you are aware. First, if there is a change in the defined, if there is an actual gain or loss on the liability. Second, if there is a change in the return on the plan assets. And third, if there is the effect of asset ceiling. The asset ceiling is not there in the question. How do you find the actual gain or loss? Or how do you find the change in the return of plan assets? Typically, how we should do it is we should prepare a statement showing the liabilities, opening liability, why should it increase, and you reach the closing liability. If there is any difference, then the balancing figure is attributable to the gain or loss due to the changes in actuarial assumptions on liabilities. Similar is the case with the assets. You should prepare a statement for the assets showing opening and trying to reach on why should the reconciliation on why should the opening increase, like the expected return, like the contribution, and ideally should type with the total closing. If it does not, then we will say that the difference is due to the changes in return. So let's get started on this question. So over here, we need to figure out what is the amount of items to be shown in the balance sheet, as well as in the P&L, as well as the statement of comprehensive income. So what we'll do is we'll actually do it in a slightly different way than what the institute is doing. The institute actually does all the calculations directly on a net basis. I prefer to do it separately, and then while presenting it in the balance sheet, directly netting it off. We'll just look at our presentation difference with the institute as well, though our final solution remains exactly the same. So what will happen is there will be a liability. Let's say there will be an asset. On 1st of April 2011, there should be some opening balance of the liability. If you see, that is 1400, and by the end of the year, that is 31st March 12, there should be some closing balance. If you see, that is also given to you in the question as around 1580. For the plan assets as well, there should be some opening balance on 1st April 11. Your opening balance is, let us say, 1140, and your closing balance on 31st March 12 is also given to you, let us say, as 1275. Now, we need to ask ourselves that why should the opening balance increase? Well, before we do that, we'll just also prepare the extract of the relevant expenses in the profit and loss and impact, if any, in the other comprehensive income or OCI. Okay, now why should the liability increase? Well, all else constant, the liability as 1 year passes is 1 year closer, and hence there will be interest. So over here, there will be interest on the liability, that is 1400 into the interest rate, which is 10%. So that is 1400 into 10% comes, into 8% comes to 112. Now the effect of this should go in the PNL. Now PNL, we show the net interest. So the net interest is the interest on the liability as net of the return or the interest that you actually got on the plan assets. So let us say there is a net interest which is on the liability. If you want to find the net amount, then you find the interest on the liability, which is an expense, in the inner column, let us say of 112. Now the similar Ind AS 19 says that the discount rate is the same. What is the discount rate? The discount rate is the expected return on the assets. So how the time value of money is how much your assets are actually going to earn. So if your discount rate is 8%, it effectively means that you are expecting to earn around 8% on the assets as well, and that is the time value of money for the liabilities. This is what Ind AS exactly tells you. The discount rate has to be the same for the assets as well as the liabilities under Ind AS. So that is 1140 into 8% should come to 91. Now it's a return on assets, and hence this will be like an income, but you don't show it as an income, you show it as a reduction from expenses. So let's say on assets you will show this as 91, and hence 112 minus 91 comes to 21. So 21 will be your net interest expense. So we will show this as net interest expense. The institute directly takes it, which is faster. However, it's a slightly difficult thing to understand for a student. So how is net interest calculated directly? Well, what they do is they will take over here as an alternative solution. They will take over here as the direct net liability, that is 1400 minus 1140 into 8%. So if you do that on your calculators, that is 1400 minus 1140 into 8%, you get exactly around 20.8, which rounded off is actually 21. So it's the exact same solution. Now, why should the liability change otherwise? Well, because you have rendered current year service, and the current year service is worth 55. So over here you have current service costs, and current service cost goes in the profit and loss account. So we'll write this in short as CSC, which is 55 rupees. So both effects are given, liability increases and the P&L gets debited. Apart from that, you build contributions. Now, in a defined contribution plan, the contribution is the expense, but that is not the case for a defined benefit plan, where the expense is calculated separately. If you were to calculate the defined benefit contribution plan, this is the expense. Now, a contribution over here is a contribution by the entity to the fund, and hence a contribution increases the plan assets. So, a journal entry is actually plan assets account debit to bank. So, we are not preparing the bank account, but we are having contributions of 111. That is not an expense, not an OCI item, and hence we just add 111 over here. Now that everything is taken, ideally your account should tally. But if you now go to the liabilities, that is 1400 plus 112 plus 55, that comes to 1567. On the other hand, your closing balance is actually 1530, and hence 13 is considered to be the actuarial loss. It's increase in the liability, and this actuarial loss will be shown in other comprehensive income as a remeasurement item. So if you are looking at something like a remeasurement reserve or a remeasurement item, that will be over here as 13. This is again on the liability. Let us say you can always show this separately, or you can always show this as a single item. Institute shows this as single. Let us say on the liability is 13. If you go to the assets now the assets also have to ideally tally, but it's 1140 plus 91 plus 111 comes to 1342. Ideally your closing is 1275, and hence that's a 67. That's a reduction, and hence you will credit the assets, and hence you will still debit the remeasurement, which is also going to the OCI. This is 67 reduction. This is change in return. change in return of the plan assets, which is in the other comprehensive income. This is 67. So this is on the plan assets. This is 67. If you total this up, this is 80. Okay. So what that takes care of the entire question. Now your balance sheet presentation. Now, if you have to present it in the balance sheet, it is always the net amount that appears. So your net amount of liability at the end of the year will be 1580 minus 1275. So your net will be 1580 minus 1275, comes to 305. So in your balance sheet there will be 305. In your profit and loss account this will be 76, and in your other comprehensive income 80. So these are the three critical numbers. 76 in the profit and loss as an expense, 80 in the other comprehensive income as a remeasurement item, and around net 305 in the balance sheet as a net net liability. Okay. Now the institute also asks you to pass the journal entry. So in the journal entry, what is happening is your P&L ultimately gets debited by, so your profit and loss gets debited by 76. Your other comprehensive income gets debited by 80. Now you are actually paying some money as well. So your bank gets credited by 111. This is the amount of contribution. And if you want to figure out the increase in the liability, the increase in the assets. So if you see the increase in liability, the institute passes a net entry. We're just doing a separate calculation over here. You can always net it off. Your liability increase will be credited. So that is to liability. This is 1580 minus 1400. That's around a 180 rupee increase. And a plan asset increase also over here. A plan asset increase of 1275 minus 1140. 1275 minus 1140 comes to around 135. Let us see if the journal entry balances. That is 76 plus 80 plus 135. That's 291, and minus 111 minus 180. That's perfect. So this is your entry balancing. What the institute will again do over here is it will net this off. The net difference will be shown by the institute. So that takes care of this question. A very important one, I would say, it helps you strengthen your understanding on the defined benefit questions. If you see P&L is 76, remeasurement in OC is 80, as we have discussed, that's 156. The P&L gets debited by 76, 80, and this is 111, the same. Just about this 45, what the institute has actually done is, if you see 135 and 180, the net difference is actually 45. They have taken the net value. The amount in the liability, actual losses balance. They first calculated the actual return and then found the difference. We have just done that directly. It's just a presentation difference. Your solution continues to remain exactly the same. As you can see, at the end of the year, the closing net liability is 305. Okay, that takes care of this question. Here we go to the next question. This is on short-term employment benefits. This is on leave carry forward. So if you read this question, we'll just discuss. It's a case, so we'll just discuss. I expect to read the question. So there are 100 employees, and these 100 employees are entitled to 5 days of leave, unused, and the unused sick leave can be carried forward to the next year. And the question tells you that once you are doing this carry forward into the next year, only that part of the leaves which will be, so okay, let's quickly discuss this. So in the question, what is happening is, if you're looking at an employee, they're entitled to a sick leave of 5 days, sick leave of 5 days in a year. Now, if you don't take this sick leave, you are allowed to carry forward. You carry forward these, whatever is the unutilized leave, unused leaves, you can carry it forward for how many years? Well, you can carry it forward for 1 year. But what will happen is, in the next year, there will also be the leave entitlement of the second year itself. So the company allows you to adjust this on a leave for basis, which means first you will adjust the leave of the coming year. So for example, there is year 1 and then there is year 2. In the first year, there is an unused leave balance of 2. In the second year, there is an entitlement of 5. So in total, you are entitled to 5 plus 2, that is 7 days of leave in the second year, because you have 2 days of carry forward, if you actually take only 5 days of leave, then these 5 days will be first adjusted on a leave for basis, which means first they will be adjusted from the current year, and then if there is any excess, so for example, if you were to take instead of 5, you were to take 6.5 days, then you will utilize the entire 5, and out of this 2, you will utilize another 1.5, and hence your 0.5 will lapse. So over here what is happening is there are 100 employees that the company has, out of which each of them were entitled to 5 days of leave, and there is a carry forward leave balance on an average of 2 days. In the next year, 92 employees are expected to utilize actually 5 days, and the remaining 8 employees are expected to utilize 6.5 days, which means, will the carry forward be utilized? Well, in the second year, for these 92 employees, they are already entitled to 5 days of leave, and if they only take 5 days, then the 2 days of carry forward is expected to lapse. Carry forward is not utilized. Instead, the entire 2 days will actually lapse. The entire 2 days will lapse. On the other hand, for the 8 employees, 1.5 days each will be utilized. However, what will lapse is the remaining half a day that is going to lapse. And as a result, as per Ind AS 19, should you create a provision at the end of the first year for the leaves that is getting carried forward? So actually at the end of the first year, your actual leaves that are getting carried forward are 2 into 100, that is around 200 days, into let us say whatever is the average salary per day. So should you create a provision for the entire 200 days? Well, it depends if you expect that the entire 200 days will be utilized. How many days are you expecting to be utilized? Well, you are expecting only 1.5 days, that too for 8 employees to be utilized, and hence that is 12 days. So should you create a provision for the entire 200 days? Well, no, because you don't expect 200 days, you don't expect to pay for 200 days, you are expecting to pay only for 12 days, and hence a provision will be created only for 12 days into the number of or the rate per day. So your provision will be created, provision for leave salary, provision for leave entitlement will be created as 12 days into salary per day at the end of the first year. Are we getting this? Okay, so that takes care of question number 1 on test your knowledge. It was also an interesting question. The next question is, OPQ is a listed company having corporate office as a branch office in Chennai. Company has been operating in the Indian market for the last 10 years. Okay, so before we actually read this question, it's very similar to an RTP question that was there. Under Ind AS, remember, there is no concept. We have studied AS 15, there will be some confusion over here, but under Ind AS, there is no concept of what you call as unvested and vested past service cost. What is a past service cost? There can be a change in plan. You might increase the benefits for the employee, and hence, if you increase the benefits of the employee, that will result in an increase in the expense. Old AS 15 had a slightly different treatment. It treated some as vested, some as unvested. Ind AS believes that if you expect that the employees are going to continue, whether they are vested or unvested does not really matter. The year in which the change happens, the entire expense has to be recorded to the profit and loss account. So with that background, we'll read the question. The company operates a pension plan that provides 2.5% of the final salary for each year of service. These benefits become vested after 7 years of service. Okay. On 1st April 18, we increase to 3%. So 2.5 gets increased to 3. So that is an increase. We call this as past service cost of the final salary for each year of service starting from 1st April 11. On a date of improvement, the present value of additional benefits, we have already quantified the present value, was as follows. Employees with more than 7 years service already rendered, that is 2,75,000. So if these employees leave immediately, they will be entitled to 2,75,000. Employees with less than 7 years of service, this is 2,21,000, average 4 years to go, so maybe they have rendered 3 years of service, but if you expect that the remaining 4 years are going to be rendered, then you also have to pay them 3%, not 2.5%, and hence, what would be the accounting treatment in this case? Well, you take the total of 275 plus 221, and hence, the entire 4,96,000 will be debited to the P&L, and a credit will go to the liability. In the P&L, this will be called as past service cost for the entire 4,96,000. That is what the question even tells you over here. The entire 4,96,000 will be taken to the P&L immediately. Okay, and the last question on employee benefits, again an interesting one. It's similar than the other question though. SA is engaged in the business of retailing, having 100 retail outlets across north and south, head office in Chennai. SA is a subsidiary of SAG listed on NSE. The following information, general introductory data. The data on plan assets is given to you on 1st of April 11. Fair value of plan assets are 10,000. Okay, so it's like a similar question only. Fair value of plan assets are given to you as 10,000. Contribution is 3,000. That is at the end of the year. Benefits paid are 300. Also at the end of the year. Fair value of plan assets is 14,700 and actual return is 2,000. So I've been given all the data points honestly over here. Same as the case with defined benefit liability. The present value at the beginning is given. Then at the end is given. Even the actuarial loss is given in this question. You could have calculated directly as balancing figure, but it is given. Current service costs and benefits paid, all data is given. Discount rate is 10%. As per India's 19 suggests if there is any amount based on the above information that should be taken to other comprehensive income, that is remeasurement. Also compute the net interest on the defined benefit. So this is very similar to the questions that we earlier did. In fact, a much more simpler version. We'll again build up the same format. So you'll have liabilities, asset, you'll have the profit and loss, and then you'll have the other comprehensive income. We'll quickly jot down the data on 1st of April 11. The liability opening balance, 1st of April 11, the asset opening balance. The liability opening balance, as you can see in the question, is 12,000. The asset opening balance is actually 10,000. The closing balance on 31st March 12, the closing balance of liability is 15,500. We're just putting down the data as given in the question. We are having a slightly different format. Then the institute, 31st March 12, answers remain the same though. Your closing balance of assets are 14,700. Now these are just balances, don't have any effect on the P&L or OCI. Now we see that why should these balance increase? Well, due to interest. Well, interest on the liability will be 12,000 into the rate of 10% as given in the question, that's 1,200. The effect of this will go in the P&L. So if you look at interest on the liability, that is 1,200. If you want to find the net interest, you should also consider the interest on the assets or the expected return on the assets. That is 10,000 into 10% comes to 1,000. This will increase and hence assets, this will be like a gain and hence your net interest is actually 200, which could have alternatively been calculated as 12,000 minus 10,000 into 10% would have also given you this same. So this is one part of the question where the question is asking to find in the net interest. We've done that as 200. Then we'll see that why should the liability change? Well, it will change due to the current service cost, which is given in the question as 2,500. The effect for this will go in the profit and loss account. Nothing goes into the OCI, 2,500. Apart from that, the liability changes due to an actuarial loss. Does the actuarial loss go to the P&L? No, it goes to the OCI. So this is a remeasurement item. This is on the liability. It's a loss and hence that is increasing the liability. Similarly, we look at the assets. There is a contribution happening at the end of the year and hence it did not impact the interest of 3,000. The effect of this will be against bank. Then there will be benefits paid. The benefits paid will be out of the assets that you have and hence that will reduce the assets, but at the same time that will also reduce the liability. An interesting thing that you should have observed is the benefits paid do not hit the P&L account because we are no longer doing the cash system of accounting, we are doing it as per the accrual. And hence that takes care of all the data points. Well, actual return is given, but we don't really take actual return in our method. We take the expected return and find the balancing figure as the changes in return. If you try to take the total of the liabilities, it should ideally tally because yes, it does 15,500. This should tally. There is no balancing figure because you have already been given the actual loss. Generally, this would have not been given. You would have taken the balancing figure. If you take the actual return, then even the plan assets would tally. But we are interested in knowing the changes in return, so we try to find it as a balancing figure. This is change in return. This is what 10,000 plus 1,000 plus 3,000 minus 300 comes to 13,700. Which means there's 1,000 difference. This is your change in return. This is increasing the plan set, so it's a gain. So over here, this is on the assets. This is 1000, and hence there is a net remeasurement gain. There's a net remeasurement gain which should go to the ICAI for 900 rupees. If you actually cross check the expected return of 1000 and the changes in return of 1000, which you actually add over here, will total up to the actual return of 2000. So basically what the institute asks you, it asks you to show the net interest. The net interest you have calculated as 200, and it asks you to find the remeasurement. In this case, the remeasurement gain is actually 900. Okay, so that takes care of the important cases which are there in Ind AS 19. This is fairly important. Now you go to the next unit, another important unit. There are good cases which are given over here. This is on Ind AS 21, foreign the standard on foreign currency. A couple of questions over here are essentially on the functional currency. So what is a functional currency? Functional currency is a currency of the primary economic environment in which the entity operates. How do you determine the functional currency? You look at primary factors, that is the currency in which sales are happening, the currency in which expenses are incurred, and the currency which actually is of the country whose competitive forces are affecting your business. If there is a conflict within primary factors, you can go to the additional or secondary factors, which is the currency in which the financing has been raised and the currency in which you are largely retaining money. While determining the currency in which sales are denominated, you don't really always look at the actual currency in which sales are denominated, but you look at the currency which influences the sales price. The example that we always quote is, if you actually go to Make My Trip or you go to hotels.com and you are booking a European hotel or a European air ticket, you will still see it in rupees. But that is actually not really in rupees. It is just quoted in rupees to you for your convenience. The price is actually in euros, converted at a rate just for convenience shown in rupees. So the sales might be denominated in rupees, but the currency which influences a European airline like Lufthansa would be the European currency, not Indian currency. Based on that, we'll quickly go through the cases. Now, A is a Oman-based company, so the location is in Oman, having foreign operations in India. The foreign operation was primarily set up to execute a construction project in India. The functional currency of A is OMR, that is your Oman currency. 78% of entity B's financing has been raised in USD. Remember, that is not in OMR, that is not in INR, that is in USD. This is an additional, this is a secondary factor which will be used if primary factors give a conflict. B's accounts are maintained in USD as well as in INR. Cash flows generated by B are transferred to A on a monthly basis in USD in respect of repayment of finance. So it appears that the amount are also retained largely in the dollar. This is also a secondary factor, not a primary factor. Revenues of B are in USD. Okay, so this is a primary factor. Its competitors are globally based. Tendering for the construction also happened in USD. We incur 70% of the cost in INR. So this is also a primary factor, and there appears to be some conflict, and the remaining 30% is in USD. Since B is located in India, can it presume the functional currency to be INR? No. This answer is definitely wrong, because functional currency nowhere mentions that the country in which you are domiciled is your functional currency. No. It is a currency of the primary economic environment in which you are, which affects you. It's a global company, and hence the competition environment is a global environment, it appears. Similarly, the sales are predominantly in the dollars, but the expenses are in rupees. So you should also take guidance of the additional factors. The additional factors point out to the financing happening in dollars, and the additional factors also point out to a large part of retention also happening in dollars. And considering all of these factors, it appears that B's functional currency should ideally be dollars. The institute has given you all of this theory, and it explains you the same thing, where they're saying that USD should be treated as a functional currency of B. So that is the first case. It's a case-based solution. Just quickly go through it. Move ahead. Now, SA is a company, which next illustration, which is based in India. Okay, location, as we have just said, is not, domicile is not the determining factor, which got listed on the BSc. Since the company's operations have increased considerably, the company is engaged in the business of trading in motorcycles. The company only deals in imported motorcycles. It's like a Harley Davidson, if you're aware. It's not an Indian company, it's a US company, but you are an Indian company who is actually importing Harley Davidson motorcycles. These motorcycles are imported in the US. After importing the motorcycles, they are sold across India. Okay, it's exactly like Harley Davidson, if you're aware. through its various distribution channels. The company has only private customers earlier, but also started corporate tie-ups and increased its customers base to corporates, include corporates as well. The purchases are in the USD. Okay, so your expense or your purchase essentially is in USD. Because the vendors are located in the US, all other operating expenses of the company are incurred in India only because of its location, and they're generally happening in INR. So a large part, except for the import of the motorcycles, every other expense is essentially in the rupee, in INR. Currently, its customers are both corporate and private in the ratio of 70:30. So corporate is 70, private is 30. The USD denominated prices of motorcycles in India are different from those of other countries. This is a very important line. This is showing you that if USD was a functional currency, then your prices would have been the same. So if you are booking an airline ticket of Lufthansa, whether you are booking it from India or whether you are booking it from Germany, the price should be the same. It should not be different. But if the price is actually different, that is because the competitive environment of India is actually shaping up the price. Though the price is denominated in whatever currency, the competitive environment in India is actually shaping up the price. A very important sentence is. The company is also expecting in the coming years that its customer base will increase significantly in India, and the current proportion might also change. So 70:30 might change. Currently, invoices are raised to the corporate customers in USD for the purpose of hedging. Okay. However, private customers don't accept the same arrangement, and the invoices are actually raised in INR. So sales appear to be a mix of rupee and dollar. The question does not tell you any information about the financing or the additional setup. So essentially, you have to make a decision based on the primary factors only. The expenses are also dollars and rupees. The import expenses are in dollars. The other operating expenses are in rupees. Corporate sales are in dollars, essentially for hedging purpose. Other sales are in rupees. But the competitive environment is clearly the Indian environment, and hence the functional currency of this company should ideally be the INR, because the primary economic environment seems to be the Indian environment, because you're having a different price in India. It's a very important indicator. And hence, if you see, we have highlighted over here that the sales prices of motorcycles are mainly influenced by competitive forces and regulations in India. The market is in competition with international brands, and hence INR should be considered as a functional currency. Okay, so that is also a case-based question. You should just go through it and move ahead. Just in case a similar question comes up, you should be well prepared to answer. Then goes the illustration 8. Now this is an interesting illustration, is linked to consolidation to some extent on how should you go ahead and do intercompany elimination. So M Limited is engaged in the business of manufacturing bottles for pharmaceutical companies and non-pharmaceutical companies. So it's a bottle manufacturing company. Honestly, in this question, I don't think enough data is given to you. The institute has solved it based on some data points. We do it at this stage based on what the institute has done, so that we are at least aware of the solution, but I don't think complete data is given in this question. M is engaged in the business of manufacturing bottles for pharmaceutical companies. It's a wholly owned subsidiary of G, which is also engaged in the business of pharma. G purchases the pharmaceutical bottles from its parent companies. The demand for G is very high and the operations are very large, and hence to cater to its shortfall, G purchases bottles from other companies. Purchases are made in competitive prices. Just in general introductory paragraph. M sold pharmaceutical bottles to G for 12 lakh euros on 1st of February 11. The cost of these bottles was rupees 830 lakhs in the books of M at the time of sale. At the year end, on 31st March 11, all of these bottles were lying in the closing stock with G. What should be the accounting treatment for the above? The following information is available. The exchange rate on 1st of February is given as 83, and that on 31st March is given as 85. Okay. Now what is happening over here is we are not really given which company is domiciled where. We have just been given that there's a company M and then there is a company N. So if you are taking at two companies, there's a company M which is a parent, and then there is a company G which is a subsidiary. Now M is making sales of 12 lakh euros. 12 lakh euros on 1st of February 11. Now ideally this sale is happening on 1st of February, so it should be recorded at the exchange rate as on the date of the transaction. That is 12 lakh euros into 83 should come to 996 lakhs. Okay, so this is in rupees, 996 lakhs. The cost of these for M in rupees was 830 lakhs. This is the cost, this is the selling price. So as a result, there will be a profit. If you actually see 996 minus 830, there's a profit of 166 that gets recorded. Now we are not really told honestly as clearly which company is located where, but if you were to find the cost of these bottles in euros, we have the cost in rupees. Let us say if you were to find them in euros, on these sales happened on 1st of February, so if you were to find the corresponding cost in euros, the cost in euros of these bottles would be rupees 830 lakhs upon rupees 83 per euro, and hence the cost is actually 10 lakh euros, and hence if you were to find the profit in euros, that is a 2 lakh euro profit. Again, this is a profit in euros, that is a 2 lakh euro profit. Now what is happening is that these at the end of the year the exchange rate changes and these goods are still lying in G as a closing stock. So we are not very sure the currency that G has, but if the closing stock is lying and let's say G has a currency of euros, that is what the question is solving it as, then this will be appearing as 12 lakhs in the books of G, and hence at the end of the year, if you were to translate, and G is a foreign operation, if you were to translate everything into rupees, then this will be 12 lakhs into rupees 85 per euro, and hence this will be 12 into 85 comes to around 1020. Your closing stock will appear as 1020. Now, at the time of consolidation, closing stock will appear at 1020. However, there might be some unrealized profit. Why? Because this is a sale which is made by the parent to the subsidiary, and hence, if there is any unrealized profit, the unrealized profit on this should be eliminated. So, what will be the unrealized profit? Well, the parent must have recorded around 166 rupees of profit already, and hence this 166 should be eliminated. Now, at what value should the closing stock appear in the consolidated books? The institute says that the closing stock in euros, now again whether this is right or wrong, it's slightly debatable, but the institute says that the closing stock in euros was actually 10 lakhs. At the end of the year, the euro value is 85, and hence the closing stock should ideally appear at 850 lakhs. So this is what they are saying should appear, and hence the difference between 1020 and 850, that is 170, has to be eliminated. Now we try to figure out that how do you eliminate 170, because your unrealized profit is actually 166 only. Then where is the remaining 4 coming from? So actually the remaining 4 is coming from the profit element. So what is happening is, because the institute is taking the stock to be shown at 850, it is trying to say that the profit is actually of 2 euros, and if you are looking at 2 euros, there will be an exchange difference also on the profit. So if you try to find the exchange difference on the profits, this 170 can be broken up into the profit that is already recorded on the cost of the or on the inventory directly, which is 166, which you want to eliminate, as well as the exchange differences on the profit. The exchange differences on the profit element will be 2 euros into rupees 85 minus rupees 83, that comes to rupees 4, and hence this is 166 and 4, that comes to 170, and hence 170 is to be eliminated. I don't think this is solved in the most appropriate manner, but at this stage, if a similar question comes to you in the exam, this is what you do. What you will actually do is, you will try to find the closing stock value in euros, the original value in euros, try to restate it, find it in the balance sheet. So what will happen is, in the balance sheet of the consolidated company, the closing stock will appear at 850 rupees, that is an equivalent of 10 euros at the closing rate, that is 85. The profit which has been recorded, because they have been unsold, and if you consolidate, you have to eliminate the unrealized profit on a downstream or an upstream transaction. So if the goods are unsold, you will have to eliminate the profit. The profit over here that needs to be eliminated is 166, which is recorded. Apart from that, because the 2 euros of profit, that is 10 minus 12, the 2 euros of profit, will also face an exchange difference, because 166 was calculated taking 83 as a base. Now that 2 rupees extra will also need to be eliminated, and hence 166 and 4, 170 will get eliminated, and 850 will appear in the balance sheet as closing stock. This is how it is. Okay. Okay, next you go to the last illustration for foreign exchange. Now this is based on the concept of net investment in a foreign operation. So what does Ind AS mention? If you are aware, if there is a foreign operation, generally every item, whether it is monetary, non-monetary, in the balance sheet has to be converted to the closing rate, and the exchange difference goes to the foreign currency translation reserve. Equity and reserves are not restated at the closing rate. However, all monetary items, all non-monetary items are restated at the closing rate. Now, equity will generally refer to permanent funding, which the parent has done in the subsidiary. Now, sometimes what might happen is the parent might give loans to the subsidiary which are without any repayment date, where the parent has no intention to repay. But because they are structured as loan and not as equity capital, they might actually become monetary items or non-monetary items, and hence they would also get translated at the closing rate. If they get translated at the closing rate, their exchange differences will actually go to the P&L to start with, and then you have to reclassify it to FCTR. Why? Because if they are a part of the permanent investment, and again repeat, this is something which is a very deep concept, we are not discussing that concept right now. I assume you would have read it, and you would know that concept, that if there is a net investment in a foreign operation, how do you identify net investment in a foreign operation? If I make permanent capital in my subsidiary, permanent investment, that is generally in the form of equity investment or letting the earnings retain in the subsidiary, that is my permanent investment in the company. Giving regular loans which are repayable after 5 years, 10 years is not a permanent investment. Trading balances like debtors, creditors is not a permanent investment. However, if you make an investment where you have no intention of settling it back, so if you give a loan, an unsecured loan, which you don't have any intention of receiving back, you've just given the loan, but you have not given a settlement date and you don't even intend to settle it, in which case in substance it is very similar to equity, though it is not called as equity, it is very similar to equity, and as a result that will also be treated as a part of net investment in a foreign operation. If it is a net investment in a foreign operation, any gain or loss on exchange translation because of that item has to be ultimately reclassified to the foreign currency translation reserve at the time of consolidation. So let us read the question on this lines. If you do not really know the concept of net investment in a foreign operation, this question would be very difficult for you to grasp that way. The concept though is, if there is a net investment in a foreign operation, it represents permanent funding in the company. Entity A, whose functional currency is the rupee, okay, has a foreign operation, that is entity B, with euro functional currency. Entity B issues to a perpetual debt with no maturity. Okay, this is an important word. Denominated in euros with an annual interest of 6%. The perpetual debt has no issuer call options or holder put options, which means it is permanent in nature. No one is going to call it back, or no one has a right to put it back earlier. Thus, contractually, it is just an infinite stream of interest payment in euros. In its consolidated financial statements, can the perpetual debt be considered in accordance with Ind AS 15, that is a monetary item for which settlement is neither planned nor is it likely to happen in the foreseeable future? Yes, it will be. Why? Because it is permanent in nature. It is perpetual. There is no call option or a put option whereby any person, the holder or the issuer, can get the money back earlier, and hence the interest might come each year, but interest is, the principal will not, and hence the investment that you have made, the principal component, is actually permanent in nature. With the exchange gains or losses on the perpetual debt therefore be recorded in equity? Yes, because it is, FCTR gets recorded in equity because it is perpetual in nature. That is what we are saying. Net investment in foreign operation, as it is permanent in nature. Okay. So you can just go through this. The question is trying to tell you that though the debt will give you interest, the principal amount as such is permanent funding, and any gain or loss on equity component is actually put into the FCTR as per Ind AS 20. It's a fairly deep concept, but if you have studied this concept, this should be an interesting case for that. Okay, then we go to the last section in terms of some changes. This is on consolidated financial statements. Honestly, chapter 4 and chapter 14 and unit 4, these questions, a lot of students, a majority of students do not study in consolidation. So this is something which, I would not really reckon, or maybe briefly I'll discuss it at some point in the video, but I would not really reckon, because this might really shake up your confidence. These are theory questions in consolidation. Almost every material or every student generally does full-fledged questions on consolidation. They don't really do the theory questions, and because in the institute in the past we have always got full-fledged consolidation questions only. So something like, what is an investment entity? Should an investment entity be consolidated? What is a venture capital association? Should it be consolidated? What are exemptions from consolidation, etc.? These are questions which most of the times a student would not have done. If you have done these questions, you can refer these 3 or 4 illustrations in this unit. The other units we will do. If you have not done investment entity, scope, exclusion, at this point I would tell you they are not really important. They have never been asked in the old syllabus. In the new syllabus as well, they have not been asked till date. And if you have not done what an investment entity is, if you have not done the scope exclusion, just skip this part. Very, very easily skip this part. It's just a theory question. There are far more questions that are there as well. Maybe you would have not done those, so you don't want to do something new. In any case, if time permits, I'll come back by the end of this video and maybe briefly discuss these parts. But in the interest of time, currently illustration number 1, I would, if you have not done investment entity or scope exclusions, you'll probably skip this. Illustration 2 also you can skip. This has no connection with direct line-to-line consolidation, calculation of goodwill or NCI. And there's an illustration number 9. We'll just discuss this quickly. It's a very simple question on control. This you should have done. And the last question. So these 4 illustrations, something which I've given to you for your convenience, but you can skip if you have not done the concept of investment entities or where consolidation is not applicable. It's absolutely fine. You can skip these for the time being. If time permits, by the end of the video, we'll just have a brief discussion on these points. We'll go to illustration number 9. Now, illustration number 9, what is the concept of control? India says control is the power that an entity has over the investee, and this power comes from existing rights which give the entity the ability to direct relevant activities. So if you have that power, in such a situation, if power exists, in such a situation you will say that there is a control as long as you have exposure to variable returns and there is a linkage between power and variable returns. So what is happening is entity AB is owning 50% voting rights in XY. So does 50% on the face of it give power? No, more than 50% gives power. The board of directors comprises of 6 members, of which 3 are nominated by AB and 3 are nominated by 1 pertaining to other directors. So which means again in the directors there is a 50-50 split, so you cannot dominate even the board of directors. All the decisions concerning the relevant activities are taken at this board meeting, which means the entity that controls the board meetings or has a power over the board meetings has control over the entity by a simple majority. Now, do we have a simple majority? No, we have exact 50, but that's not majority. As per Articles of Association, this is an important item. As per Articles of Association, one of the directors nominated by AB chairs the board meeting and has a casting vote in the event that directors cannot reach a majority decision. Okay, so casting vote is in case there is a tie, then one of the members gets an additional vote. Now, which is the member that gets additional vote is the important consideration. One of the directors nominated by AB gets that casting vote. So AB already has 3 votes, and in case of a tie, it gets 1 additional vote, and hence AB will have 4 votes. So due to that casting vote, can we say AB has control over XY? Yes, AB has control over XY in such a case. That is about illustration 9. Okay, we'll then go to the unit 5. These are interesting cases. We'll discuss them. These are smaller cases, but these are linked to bigger questions in consolidation as well. So we'll quickly discuss them. Now, if you are aware, the holding company and subsidiary company has to follow uniform accounting policies. What if the accounting policies are not uniform? Then the subsidiary, remember, has to align its accounting policies at the time of consolidation with the parent company so that the entire consolidated financial statements are prepared using uniform accounting policies. But when do you have to align these accounting policies? The accounting policies tell you that similar transactions should be accounted using similar accounting policies. So if the parent and subsidiary are in the same business and they are valuing inventory, which is the same inventory. So parent is also a petroleum company, the subsidiary is also a petroleum company. The parent values its petroleum stock, petrol stock, let us say at FIFO. The subsidiary values it at weighted average. Well, it's a similar transactions have to be accounted using a similar accounting policy. So at the stage of consolidation, the subsidiary will have to remeasure its inventory and at FIFO and then consolidates. However, if the parent is in petroleum products like Reliance and the subsidiary is, let us say, into telecom, or subsidiary is into shopping complexes like Reliance Retail, then the nature of items with the parent and the subsidiaries are completely different. So a parent can always say that petroleum should be accounted using weighted average, because we cannot really figure out which petrol is being sold. Whereas in retail, we try to sell the oldest stock first, and hence FIFO, first in first out, and hence the retail businesses recorded the stock at FIFO. Is it right to have different account inventory methods if parent and subsidiary has different businesses? Yes, because the transactions are different. So what we have discussed over here applies to the parent subsidiary cases, well, it also applies to the associate cases as well. Now H has a subsidiary, S has an associate A. Three companies are in different lines of businesses. Okay, these companies are using the following cost formulas for their valuation of inventory. Parent has FIFO and the subsidiary and associate has weighted average. Whether H is required to value inventories of S and A using the FIFO formula in preparing consolidated financial statements? Well, not necessarily, because if the parent and subsidiary are in different and associate are in different lines of businesses, then they can follow different methods, because accounting policies have to be uniform for a similar set of transactions. But if the transactions are similar, then inventory is similar, then you will have to restate. So over here, the entity should use the same cost formula for all inventories having a similar nature and use to the entity. But if the items are different, they are not having a similar nature and use, and hence it is not necessary to restate. It is no adjustment needs to be made to align the cost formula, because they are having different businesses. Second, how should assets and liabilities be classified into current or non-current in consolidated statements when a parent and subsidiary have different reporting dates? Now this is interesting. Let us say your parent has a 31st March year ending, a subsidiary has a 31st December year ending. Now a liability is actually payable in the subsidiary's books on 1st of January. Let's say this is 31st December 18, this is 31st March 19. A liability is payable on 1st of January 2020. So the subsidiary will say, well, this takes more than 12 months, and as a result, we will call this as a non-current liability. But when your parent is preparing consolidated financial statements, the liability of the subsidiary will also get consolidated, but the consolidated financial statements are prepared on 31st March 2019, which is less than 12 months away from the liability. So the question is, will you continue showing it as a non-current liability, or will you reclassify it to the current liability? The answer is you will have to reclassify it to the current liability. So over here, if it is less than 12 months on the parent's reporting date, then you will reclassify it to current liability. So it's an interesting case. We should be aware of this. Can you go to the next illustration? This is also a very interesting one. I would definitely mark this as important. Now, if you are aware, in Ind AS 1, you have a carve out where, let us say if there is a breach. So if, let's say you have taken a loan and there's a material condition of the loan, and if you breach that material condition, then the loan becomes repayable on demand. Because if it becomes repayable on demand, what is non-current liability will get classified as a current liability. However, if you receive a waiver, in which case the bank is not going to demand an immediate repayment, and hence you can again keep on showing it as non-current liability, but it depends on when you receive the waiver. If you receive it before the balance sheet date, yes, then on the balance sheet date the loan is not repayable on demand. It is a non-current liability still. But what if the waiver is received in the post-balance sheet period? If you are aware, there is a different treatment between IFRS and under Ind AS. This is a carve-out, means there is a difference between IFRS and Ind AS. IFRS says it's a non-adjusting event, and hence you will continue showing the loan as a current liability. On the other hand, Ind AS says that it's an adjusting event, and hence it will be shown as a non-current liability. In the context of consolidation, what is happening in this question, if you read, is there is an Indian parent and there will be a foreign subsidiary. The foreign subsidiary has prepared its accounts as per IFRS, and you are trying to consolidate accounts as per IFRS. Now, this foreign subsidiary must have breached, and a waiver must have received in the post-balance sheet period. Because under IFRS, this is a non-adjusting event, the subsidiary would have shown the loan as a current liability. But when you're consolidating the subsidiary, the question is, will you still continue the IFRS classification or will you have the Ind AS classification as the current liability? The answer is, well, because you are consolidating and showing accounts as per Ind AS, you will have to reclassify it and show it as a non-current liability under Ind AS. A very interesting case. We'll just read this. A Limited is an Indian company, has a foreign subsidiary B. It has taken a long-term loan. This has taken a long-term loan from a foreign bank which is repayable in a particular year. However, during the year 31st March 12, it breached one of the conditions, and as a consequence, the loan became repayable on demand. Hence, it's a current liability. Subsequently to the year end, it's to the year end, but before the approval of the financial statements, we rectified the breach, and bank agreed not to demand, in which case there is a waiver, and let the loan run for the remaining period up to maturity as per the original terms, whether while preparing its standalone financial statements as per IFRS, B has classified this loan as current liability, which is correct as per IFRS, in accordance with IAS 1. IAS is the International Accounting Standard. Whether A Limited is required to classify such loans as current? No, it will have to show it as non-current, because you are preparing consolidated financial statements as per Ind AS. You will have to reclassify this and show this as non-current. Okay, next is the illustration. Now, this is not as important. You must have done various cases in the study material based on this. Entity A is selling a 30% interest in its wholly owned subsidiary, which means after the sale, we have 70% stake. So there is no loss of control. If there is no loss of control, the transaction is considered to be a creation of NCI and not sale of assets. And because the NCI is also classified as equity, they are also treated as owners. So it's a transaction between owners, and hence if there is any gain or loss, it will be shown as other equity. At arm's length transaction for rupees 500 crores in cash and retains a 70% controlling interest in the subsidiary. At the time of sale, the carrying value of subsidiary's net assets in the consolidated statements is 1300, and additionally there is a goodwill of 200 that arose on the subsidiary's acquisition. Okay, so that is 1300 and 200 of goodwill appearing in the books. That is the total carrying value of the subsidiary. Entity A initially accounted for NCI representing the present ownership at fair value, and it recognizes subsequent changes in NCI as proportionate. How should A account for the transaction? So the journal entry, if you were to pass, is bank account debit. You are actually receiving 500. 2. This transaction is considered to be creation of NCI. You are recording that NCI initially at fair value, which means you are following the full goodwill method, and hence this is 1300 plus 200. So the entire 1500 you are giving a share to NCI. How much share are you giving to the NCI? Well, a 30% share, and hence this is 1500 into 30% comes to 450, and hence the balancing figure 50 is a gain which you will be showing directly in other equity. This is a gain which is on it's an owner-to-owner transaction. You're not really selling assets, creating any liabilities. It's an owner-to-owner transaction. We have done multiple cases on this. Will be shown as gain on creation of NCI. This is 50 rupees. That is your goodwill, as you can see in this entry, is not affected. Your statement of profit and loss also is not affected. It is directly going into the other equity. Okay, so this takes care of the subsidiary cases. Next, you are going into cases which involve a joint operation and then involve associates. This is a case that you would have probably studied even in the last study material, but we'll just quickly go through it. It's a case on joint operation. So there is a question of joint operation versus a joint venture. So what is a joint operation? A joint operation is something where proportionate consolidation applies. A joint venture is usually a separate venture, and you don't have directly a share in assets and liabilities. You are actually having an investment. Whereas in case of a joint operation, you are having a proportionate share in the operation itself. So AB and BC established a joint operation through, so that's a joint arrangement through a separate vehicle, PQR, but legal form does not confer separation between parties and a separate vehicle itself. Maybe you have formed a partnership. Thus, both the parties have rights to the assets and obligations of the PQR, and as neither contractual terms or other facts indicate otherwise, it is concluded that the arrangement is a joint operation. If it's a joint operation, remember, you have to proportionately consolidate your assets and liabilities. If it's a joint venture, equity method applies. Both parties own 50% of each of the interest in PQR. However, the contractual terms of the arrangement state that AB has the rights to all the buildings, number 1. So this is entirely exclusively for AB, owned by PQR. an obligation to pay all the debt owned by PQR. Okay, so this is also entirely AB's obligation. AB and BC have rights to all other assets and liabilities of PQR and obligations in the proportion of their equity interest. How would AB Limited present in PQ interest in PQR in its financial statements? Remember, as it is a joint operation, we cannot show it as investment in PQR and account it as under equity method. We'll have to proportionately record assets and liabilities proportionate to your share of assets and liabilities. So under building number 1, if you see, it's you're having the entire share and it's entire 240. If you look at cash, we missed cash. We have a 50% share and hence we will record 20 worth of cash. Building number 2 also we have a 50% share and hence we will recognize to the extent of 100. The debt, we have the entire 100% share, so that is 240. The employee benefit obligation, again a 50% share. This is your assets and liabilities. Equity is owner's interest. That's not equity capital for you, so we have to proportionately record assets and liabilities, and hence the 50% over here will be 50. So this is what you need to record at the time of joint operation. This is what the question is telling you. It's a very straightforward question over here. Now illustration 2 is a special case. Now again this is on joint operations. Now in case of a joint operation, what might happen is there might be a company, like in this question, there will be a joint operation, there will be A, there will be B, there will be C. So A and B have a 40% stake each and C has a 20% stake. And there is a joint operation. Remember, it's not a joint venture, it's a joint operation. If there's a joint venture, equity accounting applies. But if it's a joint operation and let's say A and B are having joint control, then A and B are going to record proportionately the proportionate assets and liabilities. Now C does not have any joint control because A and B together with the 40% stake can direct the activities jointly for the joint operation, but C also has a share in assets and liabilities. So the question is, how should you account for such a transaction? Should you, for C, show this as a proportionate consolidation, or should you show this not as a proportional consolidation, maybe show this equity method, maybe account it slightly differently? The entire discussion rests on whether C has a share in the assets and liabilities. If C has a share in assets and liabilities, whether it has control or not. Remember, in a company, when you are looking at a partnership firm, for example, there's joint and several liabilities. So even if you are a sleeping partner, you don't really go and vote, but you are still having a share of the assets and liabilities. If there is an obligation, you have to pay even as a sleeping partner. On the other hand, if it's a company, generally shareholder's responsibility is linked to his capital contribution. Now, after that, it does not really matter. If the liabilities are more, the shareholder does not have to pay anything. So this is what we mean by having a share in the assets and liabilities. So if C, irrespective of whether it has joint control or not, if C has a share in the assets and liabilities, it is considered C has joint control. C has to proportionately consolidate assets and liabilities. We'll read the case over here. Entity X is owned by 3 institutional investors, A, B, and C, holding 40, 40, and 20. A contractual agreement between A and B gives them joint control, so that's only with A and B. It is determined that entity X is a joint operation, a very important term, and not a joint venture. C is not a party to the arrangement between A and B. However, like A and B, C is also having rights to assets and obligations relating to the joint operation, which means if something happens, if the liabilities exceed, even C has to contribute. If the benefits are greater, C gets a share. In which case, there's a joint operation and C has a share in assets. In which case, even C will follow proportionate consolidation. A and B in any case have to follow proportionate consolidation, but even C will follow proportionate consolidation. Would the manner of accounting followed by A and B on the one hand and C on the other hand in respect of interest be the same or different? Your answer will be it is same, because C is having a share in the assets and liabilities. Had C not had any share, then it would have been different. Okay, so that is about the solution over here. This question is important. Undoubtedly, I would want you to refer this. So what is happening over here is there is a significant influence, and if there is a significant influence, we do the accounting using the proportionate, not using the proportionate consolidation method, but using the equity method, and hence whatever is the share in equity, and the equity can comprise of capital, equity can comprise of retained earnings, equity can comprise of OCI items, equity can comprise of even items generally shown in other equity. So whatever is the share in equity has to be added to the share of investments. Your usual entry is investment in the associate account debit to the consolidated equity, which may be the consolidated profit and loss, maybe the consolidated foreign currency translation reserve, your share of equity. Whatever items increase your equity will be recorded. Okay. Taking that into consideration, this question, what it does is, there is a company A which has a subsidiary B, and B has an associate, let us say C. Or it's the other way around. A has we just read the question, I don't remember it as well. Now entity A holds a 20%, okay, I'm sorry, there was an associate relationship. Entity A owns a 20% stake in B, who's an associate, which in turn owns a 100% stake in C. So there is entity A owning a 20% stake in B, and B owning a 100% stake in C. Okay, so while accounting for C, in B's books, B would follow full consolidation method because it is a subsidiary. But while accounting for B's interest, for accounting for A's investment in B, A will treat it as significant influence and will account it as an associate. Remember, while it does account it as an associate, it will take the consolidated balance sheet and the consolidated P&L of B, not the standalone, because A has a 20% interest in B, and B is not just standalone B, it is a standalone B along with its subsidiaries as well, and hence A will follow the equity method on the consolidated financial position or consolidated balance sheet of B. Okay, now we have entity B recognize net assets relating to C of ₹1,000 in the consolidated financial statements. Entity B sells 20% of its interest. Okay, does that result in loss of control? No, there is no loss of control. No loss of control. Entity B sells 20% of its interest in C to a third party who is a non-controlling shareholder for 300. Okay, and recognizes this transaction as an equity transaction. That is also correct. We just discussed that some time back in accordance with some para of Ind AS, resulting in a credit to B's equity of 100. Okay. The financial statements of A and B are summarized as below after the transaction. So maybe we would have passed the entry bank account debit. We would have received 300 to NCI. You would have credited the NCI and to other equity. The question directly tells you that the other equity item is 100, which must be then the NCI must be created at 200. Okay. The financial statements of A and B are summarized below. So A has shown the investment in B. B has shown the assets from C. That's an relevant extract, that is 1000. And after the transaction, B still has control and it still shows the assets. But at the same time, B has received 300 over here that we've passed. B has received this 300, and hence this 300 will also appear. Equity continues to be 1000, and there is an equity transaction with non-controlling interest owners. So this is a part directly of equity, and as we have recorded a non-controlling interest of 200. Okay. Although entity A did not participate in the transaction, A's share in the net assets of B increased as a result of the sale. B's 20% interest in C, that is of course right, because earlier you had a 20% interest. As you can see over here, your investment was 200, that was nothing but 20% of 1000. Now your equity becomes 1100, and 20% of 1100 is actually 220. So effectively A share in B's assets is now 220. That is 20 in addition to the previous share. How is an equity transaction that is recognized in financial statements of B reflected in the consolidated statements of A that uses equity method? So usually for whatever is the increase, earlier it was 1000, for whatever is the increase you pass the entry investment account debit. So even A will record investment account debit. Is there an increase in equity? Yes. How much is the increase? 100. 100 into 20% is your share, that is 20. 2. Now usually you credit the consolidated profit and loss account or consolidated retained earnings, because that is the reason for increase, profits of an associate. Now in this case, the profits of the associate have not changed. However, the equity of the associate, equity of the associate has changed, in which case you will recognize to other equity directly, to consolidated other equity 20. So what will happen is, as you see over here, in the given case, you recognize 20 as a change in other equity directly instead of statement of profit and loss, and maintains the same classification of the associate entity. B is, it's a direct credit. So this is an interesting case. If it comes, you should know, so I will rate it as important. And the last question on our additions is the one on associate. This is undoubtedly important. You will definitely mark this as important. Not really on associate, but this is on loss of control. So remember, if a control is lost, what happens? We'll just quickly discuss this. If control is lost, then you will eliminate all assets, all liabilities. But at the same time, at the time of elimination of all assets and elimination of all liabilities, what you should also do is, if there are any balances in the OCI, the balances in OCI can no longer continue to remain in OCI. Why? Because the balances in OCI are either non-reclassifiable or reclassifiable. There are certain items which are non-reclassifiable, like remeasurement reserve under defined benefit obligations, revaluation reserve under Ind AS 60, like FVOCI, fair value through OCI, equity instruments where an irrevocable choice is taken. On the other hand, there are certain OCI items which are reclassifiable, which means you transfer it to the P&L. Non-reclassifiable items, on the happening of certain events, you transfer directly to equity as retained earnings. Reclassifiable items, on happening of certain events, you transfer it to the statement of P&L and let it be a part of your net income. For example, foreign currency translation reserve, FCTR. For example, FVTOCI debt instruments, these are reclassifiable OCIs. So what are we discussing over here? Let us say your subsidiary had these debt investments. Let us say your subsidiary also had a foreign operation. Let us say your subsidiary had a defined benefit plan. When we did a line by line consolidation, we would have consolidated all assets, all liabilities, and at the same time, we would have also consolidated the post-acquisition share in the reserves. Now, if the subsidiary's interest is sold, yes, you will remove all assets, you will remove all liabilities, even subsidiary's foreign operation, even subsidiary's defined benefit obligations, everything will be removed. But your reserves, your retained earnings will still be there. Can you continue those retained earnings to remain? Well, if these are OCI items, other comprehensive income items, you will transfer a share of these OCI items as if the necessary transactions have happened. So for example, on settlement of a defined benefit plan entirely, you will transfer the balance of the actual gain or loss to retained earnings, or on sale of equity investments, you will transfer the fair value reserve into the retained earnings, or the sale of debt investments, you will transfer the fair value reserve, that is FVTOCI reserve, into the statement of P&L, or the sale of a foreign operation, you will transfer the FCTR balance to the P&L. The standard believes that if you are losing control, it is assumed, it is deemed that all of these events are happening. It is as if you have sold all the investments. It is as if you have settled the defined benefit plan. It is as if you have sold the equity investments, debt investments, sold your interest in the foreign operation, in which case the balance in the OCI item has to be either reclassified to the P&L if it's a reclassifiable OCI, or taken to the retained earnings directly. Okay, so on those lines we will read this question. As at the beginning of the current year, AB holds a 90% equity interest, which means we have control in BC. During the financial year, AB sells 75% of the interest in BC to PQR for a total consideration of 56 crores, and consequently losses, it loses control. Okay, so we are selling 70% stake, but we are retaining 20% of it, and consequently loses control of BC. As at the date of disposal, 20% interest retained by B is 16 crores and net assets are fair valued at 60 crores. Okay. Then net assets include the following: debt investments classified as fair value through other comprehensive income of 12 crores and an FVOCI reserve of 6 crores. This is debt investment. This is a reclassifiable OCI. Net defined benefit liability of 6 crore that has resulted in a reserve relating to net measurement losses. So it will be a debit balance. This is, remember, a non-reclassifiable OCI. Equity investments considered not held for trading of 10 crores, which is for which an irrevocable option of recognizing the changes in FVOCI has been availed. This is also a non-reclassifiable OCI. And net assets of a foreign operation relating foreign currency translation reserve, this is a reclassifiable OCI. Okay. In the consolidated statements of AB Limited, 90% of the above reserves were included in the equivalent equity reserve, which is perfect. Line by line consolidation, you will add the entire asset, entire liability, and your share, the parent share, will be taken to the parent's corresponding item, and remember, in all of these reserves, only the parent does not have a share, even the NCI has a share, and hence 10% is attributable to the NCI, which means in your consolidated statements, you would have recorded only 90% of each of these reserves. Be very clear about it. You would have recorded only 90%. Why? Because when you consolidate each of the reserves, you split between parent and NCI. So you would have, let's say there is an FCTR, you would have taken 90% of the FCTR in your consolidated FCTR, but 10% would have been shown as NCI. So when you eliminate NCI, automatically that 10% gets eliminated. So the reclassification entry, if any, that you need to pass is only for the part that you have recorded as a part of your share. Included as a part of NCI, you have to show the accounting. So let us first pass the entry for the sale. You have actually received money in your bank account. So that is bank account debit, I think 56 crores is what you have received. Bank account debit 56 crores. Now, if you record this, all the net assets of the subsidiary has to be eliminated, and hence you will credit each and every individual net assets which are having the fair value of 60 crores. Now, these net assets, remember, include all the foreign operations, FVTOCI debt investments, FVTOCI equity investments, defined benefit liability, everything automatically gets eliminated once you eliminate 60. But you are not when you are eliminating all the net assets, remember, you alone, you have done 100% consolidation, but 10% of these net assets would belong to NCI, and hence there would be a non-controlling interest which would be 10% of 60, which you also need to eliminate. So NCI would have a credit balance, and hence 6 would be debited. Once you debit this 6, remember, NCI share in all reserves, the 10% share in all reserves, including those shown in OCI, will also be removed. So NCI will be debited by 6. Apart from this, you are retaining investments. The question tells you that the fair value of the investment retained is actually 16, and hence you will debit that by 16. After this, you have recorded all the transaction, and hence there will be a gain on sale as well as remeasurement, if any, which will show in the consolidated P&L because it is considered to be sale of assets in totality. 56 plus 6 plus 16 less 60 you are removing, and hence there is an 18 gain which is recorded in P&L. So your question would ideally end over here. However, if you remove all assets, all liabilities, you have not removed the reserves of the subsidiary which were already there, or not reclassified the OCI items which are already there. So we go one by one. First of all, there is debt investments which has an FVTOCI reserve of 6 crores. Now, this 6 crores must have belonged, if you remember, to parent and NCI both. 90% of this would have been belonged to the parent, that is 5.4, and 10% to the NCI, that is 0.6. Now, when you remove this 6 over here, this 0.6 automatically gets removed, and hence you have to pass entry for only 5.4. Now, you have to ask yourself that is this a reclassifiable OCI? Our answer is yes, and hence your journal entry will be FVT OCI. This is for the debt investment reserve account debit. Only 5.4, that is a parent share, to the statement of profit and loss account 5.4. Then you go to the next part, that is a remeasurement reserve. That is a net remeasurement loss of 3 crores. Out of this 3 crores, 90% is your share of the loss, that is 2.7. So your journal entry will be remeasurement. Okay, you will eliminate it, it's a loss. So you have to credit it. So there will be a remeasurement loss. Now you have to ask yourself, whether this will go to P&L or this will go to OCI, this will go to retained earnings, this will go to retained earnings because it's a part of non-reclassifiable OCI, this is 2.7. The next entry is equity investments, again this is non-reclassifiable OCI, the equity OCI reserve is 4, your share is 4 into 90%, that is 3.6. As it's a profit, it will be removed through debiting the equity investments. 2, you will take it to retained earnings. This will be 4 into 90%, that comes to 3.6. And lastly, FCTR, this is a reclassifiable OCI, again it's a reserve of 8, we are assuming it's a profit, so FCTR will be debited to the statement of P&L will be credited. So this is 8 into 90%, this comes to 7.2. Okay, so this takes care of all the questions as such. At the end, we have also added some theory for CSR in CSR, there are 3 changes. These were there even for May 19, and hence probably you would have studied them, but I'll just invest the next 5 minutes at max. I've spent a lot of time actually in CSR. So what are the 3 changes? First, when you are counting the eligibility is counted taking the immediately preceding financial year only. What are the eligibility limits? Your net worth should be greater than equal to 500 crores, your turnover greater than equal to 1000 crores, or net profit greater than equal to 5 crores, only for the immediately preceding year. If the company is eligible, earlier it was immediately preceding 3 years, now it is the only immediately preceding year. There is a source of confusion among students that what about 2% of average net profit? That, remember, still continues to remain as 2% of the average net profit for the immediately preceding 3 financial years. Net profit is 2% of the average of the immediately preceding 3 financial years, but the eligibility is only for the immediately preceding year. The second change, it's not very major, is when you constitute a CSR committee, it should comprise of at least 3 directors, out of which at least 2 have to be, at least 1 has to be independent. What if the company does not have any independent director? Then you will comprise your CSR committee of only 2 directors. That is okay. And then comes the third and important change. So what earlier used to happen is we used to earlier say that what if there is a shortfall in CSR spend? You should have, let's say your profit was 10 crores, you should have spent 2% of that, that is 20 lakhs. What if there is a shortfall? The old Companies Act said that in case of a shortfall, the directors are responsible to give a reason, and hence the guidance note used to say that if they just have to give a reason, there's no obligation on them to make a contribution, and as a result, you will create no provision. You will merely give a disclosure. There is an amendment over here whereby now if there is a shortfall, in case of a shortfall, the standard or the Companies Act mandatorily requires you to do either of the 2. It mandatorily requires you to say that whatever is the extent of shortfall, within a period of 6 months, deposit into some eligible funds, deposit in some eligible Schedule 7 funds. For example, you have the Swachh Bharat Kosh. For example, you have the Prime Minister's National Relief Fund, which are a part of Schedule 6 funds, Schedule 7 funds. You deposit the money within a period of 6 months. Well, what if you don't deposit? Then you are subjected to penal consequences. The company would have to pay a penalty of anywhere between 50,000 to around 25 lakhs, and each officer in default will also be subjected to imprisonment along with the penalty, either or even both. So now you are under an obligation, or if the company is running an ongoing CSR project, then you need to deposit within a period of 1 month from the end of the financial year the shortfall in that CSR project in a special unspent CSR account, and this is like an escrow account, can be used only for eligible CSR expenses only. So long story short, you are under an obligation now to spend the unspent amount of CSR, and hence the accounting undergoes a change. You will create a provision for the unspent CSR value, because now you are under an obligation. If you understand this well, this is very similar to what you have to do in section 54 of the Income Tax Act to claim an exemption from capital gains. You either have to deposit the funds in, let's say, NHI or REC bond, section 54 EC, or you have to deposit into a separate account, which is like a capital gains account scheme, where the money can be used only for the purpose of, let us say, buying a residential property. So this is very similar to that. In order to avail exemption, you have to do either of the 2. Here also, in order to comply with section 135, if there is a shortfall, you have to deposit money either into an eligible fund or into an ongoing CSR project. Fair. So that is why your accounting changes. You now have to create a provision. You can't just say that the directors can disclose it. They still have to disclose the reason, but at the same time, they also have to deposit this money. As the obligation exists, a provision is required. Okay, so this kind of takes care of all the additional questions which are relevant for the November 2019 attempt. These are, again, I'll repeat, relevant for May 20 as well, but I've tried my best to cover everything which is possible in your, which is relevant for the November 19 exams. Just pardon me if I was a little quick, but I had to manage time because still we have, over the 2 videos, it's around 2.5 hours, 1 and 1.5 hours. At this stage, I would expect you to just at least try to remove this time, this institute released a module fairly late, just a few weeks back, so we have not got enough lead time. But nevertheless, better late than never. Better to see these questions now rather than seeing this in the main exam. I wish you all the very, very best. Do write to me if you have any doubts, any queries. I'll try my best during the coming week to solve it as soon as I can. Please feel free, even if I've missed the message, because a lot of students do keep on messaging, to put me a question mark so that it comes back again on my WhatsApp list at the top. I'll try to revert as soon as I can. Wish you all very, very best. Do well, be confident, sleep well, and wish you all the very best. Goodbye. Good luck. Thank you.